Well, hi traders, Chris Weston, Head of Research here at Pepperstone. Well, it's been a truly historic and tumultuous last few days in the financial markets. For people who've been following the yen, for people who've been following developments in the global economy, perhaps this won't necessarily come as a huge surprise, but the magnitude of the moves that we've been seeing, certainly on Monday, and that spilt over onto the Tuesday trading session and may continue to kick on ahead, certainly need a lot of focus, and we ask what are the probabilities in markets as we go on. Now, what's caused this move? We're going to look at today's session. We're going to look at the events that have led up to this situation, and therefore, if we can identify those, then we can use them in our probability and our assessment going forward as well. We're going to have a look at what happened around those periods, and if we can understand that, then it can give us some very, very key lessons in trading financial markets, investing in financial markets. And then we look ahead at the answers that the market is desperately craving to find this solution. And that's really where we are at the moment. The market is looking and asking for a lot of questions. There is a situation where the outcomes, the dispersion of outcomes in markets is very wide at the moment. And when people can't price risk, you get volatility. And we've seen a lot of liquidity and a lot of flow playing through. So I think really what we've been seeing in a nutshell is this idea about a very, very, very crowded position, in US tech, in AI-related names, in NASDAQ, in certain parts of the S&P, certainly in the Nikkei, in the carry trade. And really that's just all come unwound, or a large amount of that has all come out all at once. And that's created this huge liquidity vacuum, a huge repositioning playing through. And we've seen a lot of leverage positionings coming out of the market, and it's caused extreme volatility. Now, what caused that position? I just want to say, if people do have questions as we go, and after the session, do reach out to your account manager at Pepperstone, or hit me up on Twitter, or X as they call it now, Chris Weston _Pepperstone. And if you've got questions around anything you've heard today, love to explore those. So what's caused the situation? Well, I think really what we've been seeing is this it's one position that's just all become unwound. Now, if we take the NASDAQ, for example, as you can see from the chart here, we've got the daily chart. Forget about all the bottom oscillators. Just have a look at price now. Really, since the back end of Q3 of last year, we've seen a very strong grind up in the NASDAQ, in the S&P, low volatility ranges pushing through. There's been a strong positive expectancy that the earnings were improving. We had the Fed put in the market that people were looking at a soft landing scenario in the US and saying, well, if we were to see a slight economic malaise, then the Federal Reserve will come to the party and they've got our back, and we've got this insurance, we've got this metaphorical hug from the central bank that keeps us saying, why sell equity? But then also you get the market going up, and you get the momentum funds chasing, you get CTAs, the systematic trend following funds, adding length into the market. They hit max long positions. And what you see is a situation when you've got this positive expectancy, we get very low volatility in financial markets. You've got low volatility in FX markets, in rates, and you've got the central bank put in place. Then what happens with a lot of pension funds, for example, is they do these call overriding situations where they sell calls above the market. They take the premium from those calls, which works very well in a low volatility environment, and they use that premium to enhance the yield that they get on their underlying equity as well. So there's a lot of short volatility strategies that have come through into this. And you can see the market pushing up. So I think that's a collection of very, very concentrated positioning that we've been seeing coming through. We can have a look in the Nikkei as well. Let's go into the Japanese market. Obviously, it's been front and centre. Strong move up there. There's a lot of things that have been going right for Japan for most of this year. Obviously you've seen a weaker yen. The carry trade's been firmly in place, and the fact that the Nikkei has been priced in Japanese yen is obviously a big factor. But the economy is doing okay. They've still had, for a large part, obviously the most easy central bank policy of any sort of G10 central bank. And again, that's going to help push the momentum on. Some people like Warren Buffett talking about buying Japanese stocks. Earnings have been going up, wages have been going up, and the economy's doing quite nicely. Tourism's obviously been benefiting from that weaker yen as well. So we've seen a really strong move up there. Again, the Japanese market was very much one of the these concentration risks that we've been seeing. If we have a look at the VIX, there's obviously a million ways that we can have a look at volatility. Skew. You can have a look at wings. Call put skew, for example, but we're generally at the moment everyone's focused on what's happening in the VIX. Now the VIX is the S&P implied volatility over the next coming 30 days. I won't go into the calculation too much, but you can see that we've obviously seen an extreme move over the last couple of days. But for a large period of time, you can see that the implied volatility in the market was very low. So again, it just sort of led people to want to go out and sell volatility in the market. And those short volatility strategies, obviously very much in play. Now, if we have a look at some of the other dynamics, you can see in Japan, we can see that there's been a big incentive for retail traders and investors to borrow money. And you can see that the level of outstanding margin transactions is the highest level since 2006. So yeah, it's been going up substantially since 2020. So there's a lot of leverage in the system. A lot of retail investors were heavily skewed in domestic equities, as well as international investors who have been coming in. So again, it just sort of speaks to what we've been seeing in positioning. If we have a look at, I'm just going to sort of just go through some Bloomberg charts. If we have a look at CTAs, max long, then we can have a look at what we call risk control funds or volatility dynamic funds as well. And what we've been seeing is a situation where these pension funds, these insurance funds, which target a level of annualized standard deviation or volatility in the market. And when volatility is low, they're putting more cash into the equity market, and their cash equity allocations are really rich. And you can see these pension funds had maximum allocation into the market because volatility was low. And you can see as volatility has picked up, they've had to reduce those equity holdings. So there's billions and billions of dollars that chase markets higher, but also as volatility falls, they put more cash into the system. So again, it just feeds into this massive one-sided position that we've been seeing. Now, I think one of the other factors is if we have a look at what we've been seeing in Japan. So we talk about people chasing AI, people drip feeding the market because of what's happening in short volatility. And then we can go into what we've been seeing in yen positioning. Now, the CFTC report that comes out on Saturday for us here in Australia, Friday night US, has its faults. It looks at futures positioning in FX markets, which is very small percentage, but it does give a sense of what's happening. And you can see here that the non-commercial accounts in yen futures were near a record short position. So what we've been seeing for a large portion of this is a lot of people are using the yen-funded carry trade. So for people who've been watching this over the last few days, what essentially is happening is international investors were going to Japan, to Japanese deposits, and getting capital essentially for free, given their very low interest rates, and using that capital to go out and invest in a Mexican deposit or Brazilian deposit, get that relative interest rate differential. It's what we call the carry trade. Or they were looking to invest those funds into AI. And all these companies that were working, getting the high capital return, maybe going into very high dividend stocks or emerging market bonds. But essentially what you were doing is you were funding yourself through the Japanese banking system, and the zero, in fact, they had negative rates earlier in the year, but so zero interest rates essentially, and using that funds to get a better return. And that carry position was very rich indeed. And that's what everyone's been talking about. You can have a look at foreign investment, Japanese lending, banks lending that we've been seeing, that it's just been ramping up. You can look at the terms of the balance of payment numbers that are coming out of Japan and seeing a lot of that money going to the US. So we know this carry trade's rich. And if we actually have a look at let's have a look at what we've been seeing, and you can see that the evidence for yourself when we overlap the semiconductor index in the US relative to the Japanese yen. You can see that the Japanese dollar yen's been going up. I know there's a sort of a risk component to this, but you can see that dollar yen's been going up, and so has semis as well. So you can make the argument that a lot of this yen-funded trade has gone into high tech, Nvidia, Microsoft, and names like that, as the market's been chasing up. So have you. So really, that's where we are at the moment. This is what's caused the situation. For me, it's about carry money going into equities, into US equities, people chasing the move, a very concentrated position indeed. We saw low volatility, people selling volatility strategies, and it's just all one position. Now, something changed last week. commodities have been pretty much talking about this for some time. I mean, we've been seeing for a while now that commodity markets have been under pressure. Maybe they're showing that there's been a slower growth. But we are seeing for the first time now since 2022 a synchronised global slowdown that's taking place. And it really sort of came to a head last week when we saw the ISM manufacturing numbers coming out weaker than expected. We saw the Bank of Japan raising its deposit rate, its interest rate by 15 basis points and giving a hawkish outlook for the future, saying that they're going to continue raising rates and giving that belief that they're still going to continue to move the Japanese rates higher, which, of course, is part of the reason we've seen this unravelling of the carry trade. But I think really the straw that broke the camel's back is this idea about the US going into a recession. Now, we can debate this all day long, but the market has subscribed to a more closer probability to a hard landing thesis. We're in that soft landing camp. Now the market has moved themselves into a hard landing camp, and that changes the dynamic. And that has caused just a sharp unwind of all of those positions, which are all in the same place. That short volatility, the crowded tech trade, the crowded AI trade, the crowded carry trade, to all be unwound in a heartbeat. And it's really, for me, that idea that the thesis in the market is there, and I think they're after the central banks. So what have we seen? I mean, we can go into a number of factors, but I think what we saw in the rates trade was after the payrolls number especially, which was weak. We saw the Federal Reserve coming out and essentially telling us that they're skewing their judgment more towards the labour market, or giving it just as much consideration as inflation going forward. And that told us that the central bank in the US is now really kind of cementing the idea that we're in the late stages of an economic cycle. Late cycle investment is really where you want to be at the moment. So if you have a look at how the market suddenly just went out and changed this, I'm going to have a look at some sectors, and I think this tells you a really clear story about how people trade here. So let's have a look at S&P cyclical stocks versus defensive stocks. Takes a bit of time. So it's been coming off really since April. You can see cyclical stocks, or stocks that are very sensitive to the economic in the US, had been underperformed, had a bit of a rebound through there. But you can see they've been under pressure. So defensive areas of the market have been significantly outperforming. We can see the US 210s curve. Now, I've got this on Bloomberg, but you can do all of this on TradingView as well. But you can see that the two-year treasuries, which have been inverted effectively for a couple of years now, that means that the two-year treasury yield is higher than that of the 10-year. That usually isn't the case. Typically, you'd see a situation where the two-year treasury yield should be lower than the 10-year yield. And really, for a lot of people, is when you get that inversion, so the two-year yield trading above the 10-year yield, people say, oh, we're on recessionary watch. But really, in fact, it's the situation where, we see the rate cuts coming through and the two-year treasury yield moving down more fast at a faster clip. And it's when we start going back into positive territory that people say we're on back for a recession. So you can see the 210 trade is this idea about a recession. You can see cyclicals are underperforming defensives. People have been buying protection against small caps. You can see that in the options world, where implied volatility in calls is significantly lower than what we were seeing in puts. So people have been buying downside protection there as well. We can see that in retail stocks, which have been underperforming the broader market. We can see that in all these economically sensitive, so the high beta stocks have been underperforming. So all of these trades that we associate with a hard landing, with a recession, are very much there at the moment. So if you have a look at my interest rate charts, I'm feeding this information from the US swaps market. You can see here in the Fed, this is people making assumptions and the collective weight of behaviours and beliefs around where the Fed are going to position their policy for each meeting. And you can see for September in the Fed meeting, which is, 6 weeks away, the market's now pricing the Fed funds rate effectively at 4.86%, which implies that the market's saying currently that there's 46 basis points of cuts, or nearly 2 25 basis points cuts for that meeting, i.e. 150 basis point cut. If you go down to the November meeting, we're pricing 2.7 cuts, and then we've got 4 cuts essentially being priced for the end of the year. Now, these are meetings where the market is saying that the Federal Reserve now need to cut rates fairly aggressively. I think probably on Monday there was a situation where people were thinking the world was collapsing and that we were going to have to see intermeeting cuts from the central bank, which is never going to happen. The Federal Reserve never wants to do that because they will shock the market if they do that. And I think in this situation, the data isn't there. I mean, I know we're seeing a slowdown in US jobs. We've seen 2 non-farm payrolls prints where the unemployment rate moved up 0.1%. And then 0.2%, and people are saying, well, the unemployment rate is accelerating. We've seen this so-called SARM rule being triggered, where the 3-month average on the unemployment rate has moved up 50 basis points or half a percentage point from the 12-month low. And they're saying, this is a precursor for recessions. But, some of the data is still not that bad. The ISM services numbers okay. I mean, GDP is sort of tracking around 2.5% at the moment. Fine, we are seeing a call of the labour market, but it's not terrible, but people are ratcheting up their recession bets at the moment. But I think the market got a little bit overzealous in terms of the pricing. But now they are saying that we are seeing a cooling. We are seeing that recession being looked at very much more closely. And now they want a response from the central bank. And this is where it comes into the situation about what the market wants going forward. So let's have a look at some of the charts that we've been seeing around this. Obviously, when we saw the market moving ever closer towards this recession trade, something snapped. Everything got unwound at one time. We saw equity come cratering down. Certainly it came out in Asia, and that really came down to those margin positions that we've been seeing from both leverage traders, but also from other parts of the market, really coming under pressure. When the market moved lower, what we saw was false selling playing through. A liquidity event came through, a VAR shock, they call it. And there was a lot of false selling. That triggered optionality to come through and people looking to take those short vol trades off the table. In fact, with the gamma position in the market, that meant that dealers had to go and sell the futures to push that down. Systematic trend followers have been pushing short positions now in the market. And it's been a whole concertina of different flow-based effects that have taken the market down and had exaggerated moves that we'd be seeing. If you have a look at the VIX, we did trade up to, the market got to 65%. I think that was an anomaly because if we have a look at our pricing, which is priced off the futures, we only got to 36%. So there does seem to be something that happened in the pre-market that meant, we saw that move up to 65%, which is an extreme level of volatility in the market. What we need to do now as traders is, now that we're trading around sort of 23% in the futures, which is our price, which is the cash market, which is priced off futures, this is something, and we're trading a little bit higher on the underlying spot at the moment, around sort of 27%. This has huge implications for our trading, and we'll discuss that in a second. But you can see an extreme move that played through. The Japanese, the Nikkei volatility index got up to 70%. And we can see that huge move that came down and then this capitulation sell-off. And look at that candle that we've been seeing coming through. And what I've got here is the effectively price relative to its 5-day exponential moving average. And we actually see that going to about 8% below that 5-day exponential moving average, which tells me the thing has just got so stretched. I know a lot of people use Bollinger Bands and various factors just to see the extremity of the move. But this was a 7 or 8 sigma move, a multi-standard deviation move that just shows how rare these kind of plays were. The banking sector in Japan was down nearly 14 or 15% on the day, which is just incredible. And that speaks to the idea that a lot of this money that had been lent out by the Japanese banking system for the carry trade was being repatriated back to Japan, and they're going to lose their earnings fee going forward. But also we saw an incredible move back in the Japanese yen as a result of that. Now, obviously, the yen is now central to everything that we've been seeing. If we have a look at the moves in the NASDAQ, I'm going to go through in the yen and think. Big move down into 17,250, and now we're just consolidating around there again. I'm going to talk about the future and the outlook of there. Mexican yen has been the poster child of everything carry related at the moment, because that's been your high beta play. This is where so much capital has been in there because of the relative yield differentials that you can get in Mexico relative to Japan. And yeah, that's just been on a one-way 10, but massive range expansion playing through. And again, we're just sort of consolidating, playing through here as well. So that's just where we were. We saw all of this flow-based activities causing a liquidity and really a capitulation move, if you want, in all that positioning. Now, I think a lot of that positioning has come out. And where are we now? So we've talked about what's happening in Actually, let's have a quick look at dollar yen as well, because again, this is another one that's just been breaking levels after levels after levels. We got down to 142, not far off where we were in the December lows. But again, that's been an incredible move. And I think now, as we go forward, given the importance that we've seen of the yen relative to semis and how that's feeding into the global economy, I think dollar yen is central. Mexican yen is very central to what we've been seeing coming through in markets. Okay, so where do we go from here? We've seen the extreme volatility that's come back a little bit. We've seen the repositioning that's taken place all at once that's led us to a much cleaner structure in the market. But now the market wants answers. The market's priced in an element that we could be seeing a recession in the US if we're not already in the recession at the moment. We've seen an incredible level of rate cut expectations being priced into the market, although they have been walked back a little bit. And one thing I think is a really good way of looking at this is the idea of if we have a look at the Fed funds effective rate, which is where the cost of money is effectively. This is the real sort of interest rate that they have in the US, and that sits at 5.33% at the moment. And if you take away the 2-year Treasury yield, you can see that the 2-year Treasury yield is now 133 basis points, or 1.33% below that level. And we got up to about 1.7%, and that means the 2-year yield is below where the Fed funds effective rate is at the moment. And that tells you that the market is saying that policy rates are too high at the moment. They need to come down. They're too restrictive. When you've got a slowdown in growth and you've got restrictive policy, really, especially if you adjust them for inflation, real policy rates are too high. They need to come down. The market is screaming at the Fed now, you need to do something right here, right now, or you're going to have a much more prolonged recession on your hands. So, what's going to move markets from here? Well, there's two things. When the market is pricing rate cuts and 8 or 9 rate cuts over the next year, and they're seeing evidence that there is a cooling, but they're saying we're pricing in now a hard landing, what now needs to happen is really what happens with the data. We need to be validated in that position. So what are we going to be looking at? Jobless claims. Last week we saw them move up to a 1-year high. There's been a big move up in continued claims, but the jobless claims have moved up to about 249, the 1,000. The 3-month average has been moving up. We're going to be looking at CPI next week. If that comes in low, that could cause some relief to markets. Bit of pessimism coming out from extreme negativities. But if we were to see it coming out hot, I think that's going to be, a big sort of no for the market, because this idea about slower growth, but an inflation number that potentially troubles the macro narrative, I think will cause higher inflation, so higher volatility. So watching that CPI number. Retail sales numbers, I think the growth dynamics and the growth data points are really, really important now. The market's expecting the advance read to grow 30 basis points month on month, but it's the control group element that I think really needs to be paying attention to. The control group element takes baskets from the GDP calculation, or the retail sales element that feeds directly into the GDP calculation, and it takes that control group of that basket, and that's really the sort of focus of the market, I think, and that's only expected to grow 0.1%. So if any of that falls into negative territory, I think that could really feed into this idea that we're seeing a clear slowdown. So I think that's a really, really, really important number to look at. We've got various factors, the ISM, the service, S&P global manufacturing numbers, and then we're going to be listening to Jerome Powell speaking later this month at Jackson Hole Symposium, and the market will want to see or expect to see him opening the door very, very closely, not just to a 25 basis point cut, but to what the market is pricing in terms of a 50 basis point cut. So that's the macro dynamic. If we see better data, this idea that we're pricing in a hard landing now, or we're certainly subscribing to that. You've seen that in the 2s, 10s curves re-steepening, the way that cyclicals have been massively underperforming defensive, the volatility in the market more broadly, high beta underperforming low volatility beneficiaries or defensive areas of the market. The market is saying that they've recalibrated their portfolios to be in a situation to monitor a slower growth situation. So if we get better data, that challenges what's in market pricing, and you could see some strong relief playing through. But that might not happen overnight. And so central banks then need to come to the party and share the same level of urgency that market's pricing. If they don't, bang, we get volatility. The market will go after the Fed, and we'll see tighter financial conditions and higher, and we'll see equity markets take another leg lower, and that yen could really re-strengthen as well. Now, let's have a look at the charts and the levels we're seeing at the moment. So that's kind of the macro tactical play that I've got in the system. I don't think we're out of the woods yet. If the data comes in better, fine. Yeah, I think we're going to see a strong rally. I think these names like Nvidia, which have come down to much more reasonable valuations, a lot of that positioning has come out from a very concentrated position, will give a strong rally. But it's the data that counts now, and the central banks that come to the party. Will they share that urgency? If they don't, bang, we get high volatility. The market has shown you that that's the case. Have a look at the way that Japan's trading at the moment. You know, we traded down here. We had every opportunity on Tuesday's trading session to try and break through Friday's closing lows, through the Monday's high. We saw people selling straight into that. You can see that with the candle. The market was unconvinced. The buyers tried to make their case. They got smacked back down. Indecision playing through. Now we're seeing a little bit of buying coming through in today, but I think if we can get the Nikkei back above these levels here, then yeah, I think the market will be showing you that there could be a trend developing, and I think that's a situation where momentum strategies work. I said in a note during the week, don't buy the dip, buy the rip after the dip. Now, obviously, if you're buying into these levels here, that's for the bravest of souls. Very, very aggressive indeed. I want to wait the market, starts chasing this a little bit more and giving us some conviction that they're happy to continue buying. Now, I think we want to get through these levels here, and then we can look to buy for higher levels there. Obviously, trade to that this could roll over at any time. So we just need to understand how that works out. Obviously, when you're trading trend following strategies or momentum strategies, a lot of breakouts do fail. So obviously, you need to be cognizant of that. And we have a look at the Nasdaq as well. Again, we've pulled down here. There's a lot of people who have been buying into this move down into 17,200. Again, I think we need to see a break through these highs back here to back above the 5-day exponential moving average. A close above that level will give me some confidence. The market now, if we have a look at the ranges taking forward, and this is a really important situation for trading high volatility markets, average true range, average daily range, have a look at the high-low levels that we've been seeing. You can look at Bollinger Bands and have a look at the volatility in the market. But what we're in a situation now is a high volatility, high range regime. And what that means for me is when you've got volatility at these levels, the propensity or the possibility of a 1-2% move in these equity indices, or similar sort of moves in the FX markets without any news is very high. So you've got to be in front of the screens. We really don't want to be carrying too much risk overnight, because you can't react to those situations in this kind of volatility. But also when you're seeing these kind of ranges playing through, you've got to trade with a wider stop. Essentially, you've got to trade with a wider stop. You've got to take more risk in a position, otherwise you're just going to get stopped out when we're seeing this kind of movement. And that means taking your position sizing down as well. We've got to be in fitting with the volatility in the market. When you're seeing high volatility markets, you've got to adapt to the backdrop that you're in. And that's exactly what we're seeing. So if you continue to trade with a tight stop, when you're seeing the market zip around like this and having these massive moves, you're just going to be stopped out, and you have to reload that position. So you've got to take that out, and you've got to take the position size down to compensate. And that's why I use things like average daily range, average true range, and other factors as well. But I think, at the moment, if we can push back through these levels, then I think that this can rip, and I'm open-minded to where this could go. That said, if we break in the Nasdaq and these markets back through these levels, all these buyers that took back here, they're going to be offside, and they're going to look to the weaker hands. They're going to look to close. So I feel until we get the answers from the market doesn't have that visibility. And when you don't have the visibility to price the risk in the future, to price confidence in the future, you get the volatility because the dispersions are out there. So that's what we're looking at very, very closely. We talked about what's happening in the yen, I think also in gold. And I'm really surprised with what's been happening in gold. I would have thought, given what we've been seeing in rates markets, what's now being priced into rate cuts, that the gold prices should be above 2,500 now. But what's actually been happening is that gold has just been caught up in this whole liquidation that's been taking place. And it hasn't been a safe haven. It's just been, just any old asset in that situation. That said, I think we've got a really nicely defined range of 2480 down to the double top neckline 23.52. If it breaks through those levels, I think you've got a nice move lower. But I think it's likely to chop around. Tactically, I like the upside, but price at the moment is keeping me fairly subdued. So we'll leave it there. I think in the short term, you've seen these massive ranges playing through. We're watching the Nikkei, we're watching Japanese banks, we're watching the yen very closely, because as we saw there's a lot of money that was involved in the carry trade, and the influence of the yen that's having on AI names and US equities is there. As the yen strengthens, you see equity markets lower. As the yen weakens, you see them higher. But that said, the carry trade works very nicely when interest rate differentials are there. The fact that the Bank of Japan may hold off from raising rates again is there. But the other factor is that the carry trade works very well in low volatility environments and when positive trending equity markets. And that's obviously not the case at the moment. So I wouldn't be necessarily breaking back into carry positions at the moment. But what we've seen has been this massive exercise in understanding concentration risk, in understanding crowded positions, whether it's in tech, whether it's in NASDAQ, whether it's in carry, the yen. It's all come unwound at one time and causing this massive vacuum in positioning and forced selling all at once that caused these historic moves. Now we're at a much cleaner position, but the market wants answers, and that answers has to come from the US data. We've priced in a hard landing, or there's an element of price rounding. We've seen that in the trades. Will the data justify that position? If it doesn't, you're going to see markets rip, and this is a great time to be long. If the data comes in worse from here and the central banks don't give that level of urgency, we go lower. We're in that hiatus period at the moment, which means you've got that uncertainty and that creates volatility. So be safe out there, understand the risk, adapt to the volatility. If you've got any questions, do reach out to the team at Pepperstone. Good luck.